Ever wonder how financial information is meticulously recorded and reported? Enter the accounting cycle and journal entries, your roadmap to financial clarity. Each step is crucial, from capturing transactions to creating meaningful reports. Picture this: every entry is like a piece of a puzzle, fitting perfectly to reveal the big financial picture. As we dive in, unravel the mystery behind these essential steps. Let's explore the intricate world where numbers tell a story. Join us on this journey of precision and insight. Ready to decode the language of finance? Let's begin. What is the accounting cycle? It's the systematic process businesses use to record, classify, and summarize financial transactions. Picture it as a recurring workflow turning raw data into financial statements. Every purchase, sale, payment, and receipt flows through this cycle, ensuring accurate financial reporting. Spanning a month, quarter, or year, this cycle is the backbone of tracking financial health. Mastering these steps is key to understanding how businesses operate. Ever wonder how all those numbers and transactions come together to create financial statements? The 9 steps of the accounting cycle hold the key. From preparing the trial balance to analyzing documents and recording journal entries, each task in this systematic workflow is crucial. Just like building blocks, these steps piece together individual transactions into the big picture that stakeholders rely on for decision-making. It's a structured process that ensures accuracy and clarity in financial record-keeping. So, let's dive in and uncover how each step contributes to the final financial statements that drive business decisions. Ever wondered how businesses ensure accurate financial records? It all starts with step 1, identifying and analyzing transactions. Source documents like receipts and invoices provide the evidence needed for recording transactions correctly. By analyzing which accounts are impacted and verifying the monetary impact, businesses confirm the legitimacy of each transaction. Not every business event translates into an accounting transaction, only those with clear financial implications. Remember, meticulous attention to detail at this stage sets the foundation for precise financial reporting. In the second step of the accounting process, we dive into recording journal entries. Here, transactions find their place in the general journal through the double-entry bookkeeping system. Remember, each transaction impacts at least 2 accounts, upholding the basic accounting equation: assets equal liabilities plus equity. When recording, note the date of the transaction, list debited accounts before credited ones, ensure debit and credit amounts match, and provide a brief transaction description. Remember, debits are on the left, credits on the right. Debits increase assets and expenses, while credits boost liabilities, equity, and revenue. This principle forms the bedrock of double-entry accounting. Imagine your company purchases office supplies for $500 in cash on March 15, 2024. The transaction analysis reveals a clear shift in assets. Office supplies increase by $500 while cash decreases by the same amount. This balance is captured in the journal entry: debit office supplies for $500 and credit cash for the same. The accounting equation holds steady, showcasing the zero-sum impact on total assets despite the internal asset reshuffling. In essence, while the composition of assets changes, the overall balance remains intact. As we move to step 3, posting to the ledger, we transition from the journal to individual account ledgers. Here, we transfer key details like dates, accounts, and amounts, updating balances and cross-referencing for easy tracking. Just like assembling pieces of a puzzle, we consolidate all this information in the general ledger to reveal a clear financial picture. By carefully posting transactions, we ensure accuracy and maintain a comprehensive record of all financial activities. Have you ever wondered how accountants ensure accuracy in financial reporting? Step 4. Preparing the trial balance is a critical checkpoint in the accounting cycle. This worksheet lists all ledger accounts and their balances, ensuring that debits equal credits before adjustments are made. It serves as a starting point for adjustments, simplifying financial statement preparation. However, a balanced trial balance doesn't guarantee accuracy. It won't catch errors like posting to the wrong account. Careful analysis and adjusting entries are key in the next steps. Remember, accuracy goes beyond balance. The trial balance, a crucial step in the accounting process. Ever wondered how businesses ensure their financial records accurately reflect revenues and expenses? Enter adjusting entries, crucial updates made at each period's close on the accrual basis of accounting. These entries tackle accruals, capturing revenues and expenses not yet recorded, deferrals, allocating prepayments and unearned revenues appropriately, and estimates, handling judgments like depreciation and bad debts. Think of them as the fine-tuners of financial reporting, ensuring accounts are shipshape before the statements are finalized. So, next time you review financial reports, remember the meticulous work of adjusting entries behind the scenes. Ever wondered how financial statements capture all business activities, not just cash exchanges? Enter accruals, the unsung heroes of accounting. Accrued revenues, like that $2,000 consulting job finished in December but paid in January, prompt entries that match revenue with the period it's earned. Picture this: debit accounts receivable, credit service revenue. On the flip side, accrued expenses handle situations like December wages due in January. Swiftly record the $3,500 owed with a debit to wages expense and credit to wages payable. These entries ensure transparency and accuracy, aligning income and expenses with the time they occur. In a nutshell, accruals make sure every dollar finds its rightful place in the financial statements. Ever wonder how businesses align cash transactions with revenue and expenses? Deferrals play a crucial role in ensuring accurate accounting. Take prepaid expenses for example. You pay $12,000 for a year of insurance, and after 3 months, $3,000 should be recognized as an expense. On the flip side, unearned revenues involve recognizing income as services are provided. When a customer pays $6,000 upfront, after 2 months, $2,000 can be recognized as revenue. By deferring these entries, costs and revenues are allocated correctly, painting a clearer financial picture. Remember, in accounting, timing is everything. As we move into steps 5 and 6, we reach a crucial stage in the accounting process: the adjusted trial balance. This essential document captures the impact of all adjusting entries, ensuring our financial records accurately reflect reality. By taking the unadjusted trial balance, incorporating adjustments, recalculating balances, and confirming debit-credit equality, we lay the foundation for precise financial statements. The adjusted trial balance is more than a mere list, it's a snapshot of our financial truth at the period's close. Without this step, our statements would paint an incomplete and potentially misleading picture, focusing on cash rather than our true economic standing. So, let's remember the significance of this meticulous process in revealing the real story behind the numbers. Ever wondered how financial statements come to life? Step 7 unveils the magic: preparing financial statements. Here, the adjusted trial balance serves as our guiding light, leading us to craft the trio of financial pillars. First up, the income statement, revealing the financial dance of revenues and expenses, showcasing the net income or loss. Next, the statement of retained earnings steps in, narrating the tale of retained earnings journey, beginning balance, net income, dividends, and the grand finale, the ending balance. And finally, the grand reveal, the balance sheet, a snapshot frozen in time, showcasing assets, liabilities, and equity, all intertwined with the previous statement's ending retained earnings. Each statement, a chapter in the financial saga, intricately woven to paint the full picture. So, from the inception of income to the culmination of balance, these statements breathe life into numbers, shaping the financial landscape. And remember, in the symphony of financial reporting, each note matters, each statement playing its vital role, orchestrating the financial narrative. As we dive into Chapter 3, Closing the Books, we reach a pivotal moment in the accounting cycle. Closing entries serve as the bridge between past and future, shifting balances from temporary accounts like revenues and expenses to permanent accounts such as retained earnings. This crucial step sets the stage by resetting temporary accounts to zero, primed for a fresh start in the upcoming period. Remember, while permanent accounts like assets and liabilities continue their journey into the next period, temporary accounts embark anew each time. So, are you ready to close the books and pave the way for a seamless financial transition? Ever wondered how financial accounts are closed at the end of a period? In Step 8, we tackle the 4 closing entries method. First, revenue accounts are debited and income summary credited, transferring all revenues. Next, debit income summary for total expenses and credit expense accounts. Then, depending on net income or loss, debit income summary and credit retained earnings. Lastly, close dividends by debiting retained earnings and crediting dividends, transferring payments to shareholders. This systematic process ensures a clear financial picture for the period. As we delve into the closing entries example, we're tasked with finalizing the books for a company. With adjusted balances in hand, like service revenue at $50,000 and dividends at $5,000, we navigate through the closing entries process. Initially, we transfer service revenue to income summary, ensuring a clear financial snapshot. Next, we allocate expenses like rent, wages, and utilities from income summary, painting a comprehensive financial picture. By reconciling income summary with retained earnings, we solidify the company's financial standing. Lastly, we close the loop by reconciling retained earnings with dividends, ensuring a balanced financial outcome. Through these meticulous steps, temporary accounts are reset, and retained earnings witness a $5,000 increase. The key takeaway? A methodical approach to closing entries ensures financial clarity and accuracy. Welcome to the final step in the accounting cycle, the post-closing trial balance. Here, we focus solely on permanent accounts, assets, liabilities, and equity, ensuring that debits still equal credits after closing entries. This crucial statement acts as a verification tool, confirming a balanced ledger before the new period begins. By showcasing clean slates with zero balances in temporary accounts, we set the stage for the next accounting period using these opening balances. Remember, the post-closing trial balance should contain no revenue, expense, or dividend accounts. If you spot any, a closing entry may have been missed. Now, let's ensure our financial groundwork is solid and ready for the next phase. Timing, approximately 40 seconds. Takeaway: the post-closing trial balance ensures accurate financial footing for the upcoming accounting period. Have you ever wondered how companies organize their financial statements over time? The accounting period sets the stage, defining the span of these crucial documents, be it a month, quarter, or year. Daily transactions are meticulously recorded, ensuring accuracy throughout. Monthly or quarterly adjustments keep management informed, while year-end marks the completion cycle with detailed reports. As a new period begins, temporary accounts start fresh, ready for another round. It's a dynamic process of financial storytelling, each chapter building on the last. Are you ready to master the accounting cycle? This systematic process ensures accurate and consistent financial reporting. Remember, every transaction in the double-entry system impacts 2 accounts, maintaining balance. Adjusting entries are crucial for recording revenues and expenses correctly. And don't forget, closing entries reset temporary accounts for a clean slate each period. By understanding and applying these principles, you ensure financial information is accurate and decision-ready. Master the accounting cycle for a strong foundation in accounting practice. How well do you know the accounting cycle sequence? Let's put your knowledge to the test. Arrange these steps in the correct order by numbering them 1 to 9. 1. Identify and analyze transactions. 2. Record journal entries. 3. Post to the ledger. 4. Prepare unadjusted trial balance. 5. Record adjusting entries. 6. Prepare adjusted trial balance. 7. Prepare financial statements. 8. Record closing entries. 9. Prepare post-closing trial balance. Remember, it all starts with identifying transactions and ends with the post-closing trial balance. Mastering this sequence is key to maintaining accurate financial records.